So tonight we're going to talk about financing your small business. And if you have questions, I'll be glad to answer those questions as we go along. And at the end, there'll be plenty of time as well to answer those those questions. I don't know if you had a chance to look at the PowerPoint beforehand, but we cover a number of different things, not just on the entities in which you can get financing, but the things that you have to keep in mind in order to be able to get financing. So this is kind of encompassed in a lot of different ways with that. So just kind of hitting on some things. Great. Now this is not working tonight. Okay. So in looking at this, and talking about small business and financing, we got to keep in mind things have changed. We've done this workshop for a lot of years, but things have really changed over the last couple of years. Okay. And in that, of course, you have pandemic that comes up. We have a lot more natural disasters. We have economic unknowns that come up. And then, of course, as I nicely highlighted for you in red, we have lots of scams and frauds schemes that now come up that plague people as well. So as we go through and we talk about some things, all these things have had an effect on how we run our businesses and how we finance our businesses. And so we have to address those along with just the basic principles of small business. And we're going to get back into those in a few minutes. But one of the things I always tell people when they're wanting to finance a business, I want to talk about that. You have to look at, first of all, are you a startup business? Because you've got different costs probably than an existing business. So, what is it going to cost for you to open your business? Where if you're an existing business, it might be that you're looking more at operating costs. You might be looking more at expansion costs. So you have to look at those different things. It has an effect because you may have similar needs, but very different needs. But then again, your resources for funding can be quite different. For example, there will be some funding sources that will not loan to a new startup business, but they will loan to an existing business. And then you have other entities that they would like to focus on a new startup, but they're not interested in a business that's been going along because it's established. And they may not want to work with the pattern of business that's there. So again, realizing a startup business has some pros and cons, an existing business has some pros and cons when it's time for financing that business or gaining some finance. And another thing that I always want to make sure and talk to people about is, do you know how much you need to finance? What are your financial needs? So when you're looking at this, you need to know what it is you need to have to be successful, okay? A lot of times people fail to plan and they don't ask for the right amount of money. And that sounds a little odd, I'm sure, but you think about it, people take a list of what they think the expenses are going to be, and then they just kind of run through those expenses and go, okay, this is how much money I need. And they forget about things like their operating costs until their business gets established. They don't think about, is the business going to pay me? Or what's going to happen when I've got to repurchase inventory or something like that. So again, it's knowing what it is that you need, how much money do you actually need? And you've got to look at this in a very finite way. So what are my startup costs? What are my monthly expenses? What am I going to do if something arises? And we're going to look at each of those items a little bit more in depth in just a few minutes. One thing that I find is people fail to plan to pay themselves. And I always get the answer, well, that's in my salary plan. No, the business doesn't pay you a salary. The business pays other employees' salaries. The business pays you an owner's draw. And the reason why we call it an owner's draw is you only draw money if there's money there. you're the last one to get paid. And that seems kind of opposite to a lot of people and what they're thinking. But when the bills have to get paid, the monthly bills have to get paid, the inventory has to be repurchased, you have employees to pay, you're the last one that gets paid. So we call that an owner's draw. And so you have to figure out what it is that you want that business to pay you. Now, be realistic. If I am currently working a job where I make $35,000 a year, and I decide I'm going to open up my own business, and I now want that business to pay me $75,000 a year, why is the business going to give me a $40,000 raise? Why is a new business, a new startup, going to be encumbered or be saddled with paying me $40,000 more than what I've been making? And, it's realistic that you might get paid $75,000 by your business, but there has to be a reason for that. Okay. And one of the best ways I can tell people to figure out what is the base owner's draw is if you look at the dollar amount that you expect that business to pay you. Okay. So let's say you want to pay you $50,000. Then you would take $50,000 plus then you would add 35%. So 35% of 50,000 plus 50,000 would be what that business would need to pay you in order for you to be equal to what you have been making at another job at 50,000. So go back to my original example. If I was making 35,000 on my job and I wanted to start a new business, but I want to be compensated at least the same amount, that would be 35,000 plus 35% of 35,000. That would equal out to what I'm currently being paid in the fringe benefits that I'm receiving from my current employer. So you need to figure out what it is that the business is going to pay you and what is it reasonable? Now, let me tell you this. If the business can't afford to pay you, then the business cannot afford to be it cannot afford to be open. A business should pay its owner. All right. So you need to think about that. Put that owner into your cash flow to make sure that you're generating enough profit that you get paid. Okay. If not, then you better look at the business and figure out what it is that the business needs to do differently in order to make enough money. I will tell you there are examples where business owners have started out with a modest amount and then they increase it over like a year and then they increase it every year. So they might give themselves 3 years to build up to what they want the business to eventually pay them. Something like that is quite, that's a good plan if you can afford to do so. So again, it's figuring out the increments, but the business should make sure that it can pay the owner something. Okay. All right. So along with the business paying, you need to know how much you need for operating capital. Operating capital are those monthly expenses. How much is it going to cost me for my utilities? How much is it going to cost me for my insurance? How much will it cost me for my to pay my salaries to my employees? So you need to figure out how much you need to operate. Okay. And I tell everybody a minimum is 3 months of operating capital. Typically, you even want more than that. Typically, you want 6 months, maybe even a year, depending on the type of business. How long will it take this business to get up off the ground and really get making money? But operating capital is essential because if you don't have the money to pay the bills, you can't keep the doors open. And you need to make sure that you have that money in an account somewhere up front that you can draw it off of. And that is not using credit cards to just fund things monthly if you can't pay those credit cards off. So that's another thing that will just dig you deeper in debt. So you have to look at it from that perspective. The other thing is you need to know how much will it cost you to for building your business. So actually physically building the business, purchasing a building, renovating a building, whatever it may be, what is that going to do? And then equipping the building, inventory, display racks, equipment for making whatever the product might be that you're making, or the providing the service that you're providing. Anything like that has a cost factor to it, and you have to be aware of that and count for that as well. So let me give you an example. Startup costs. This is a fictitious business. It would be like a termite business, I guess chemical spray, whatever. So if you look at startup cost, and going through looking at rent deposit, lawyer fees, accountant fees, cell phones, fax machines, postage, truck insurance, anything and everything you can think of, uniforms. The startup cost for this sample business is $74,138. Okay. You would want to do likewise. You want to sit down and say, for my startup business, this is everything we're going to need. And you would lay out every figure that you would possibly need to open those doors. Okay. How much is that? All right. So you look at all these different things and you come up with your figure. This is $74,138 just to open the doors. All right. Keep that figure in mind. Then you got to look at your monthly overhead. What's it going to cost me to keep the doors open? Okay, I have rent, I have electricity, I have my cell phone, I have my advertising, I have my salaries, I got my draw, I've got a loan payment, I've got insurance, I've got miscellaneous, I got inventory repurchase in there. Okay, $10,950 is the basic overhead for this company. So again, what will it cost you on a monthly basis to pay your bills? And that's what you need to look at. You know, you can give best guess, always go high, never go low, always go high. And I want to draw your attention to the inventory repurchase. That is huge, because if you're using anything that's consumable, if you're selling a product off the floor, if you're using chemicals of some sort, anything like that, you've got to be able to replenish that. So you have inventory repurchase in there, which is a set amount saying, I will spend at least this every time to be able to replenish what it is that I am using. Okay, so you want to keep that figure in mind. So again, monthly overhead for this sample business, $10,950. So based off of that, you would look at the startup cost, $74,138. You would look at least 3 months minimum of your overhead, $10,950. And you would take and add those two figures together. So the minimum that you would want to go and ask for when you're trying to finance this business would be $106,988. That would be the minimum. If you thought you might need longer as far as overhead cost, operating capital, then that would increase it. Okay. But again, looking at what is it going to cost me to do business? How much do I need to borrow? Because here's the thing. You know, you can make this big sales pitch to get somebody to loan you money. Well, what you don't want to do, and what you usually can't do, is go back in 6 months and go, I made a mistake. It's costing me more than I thought it would cost me, and I need more money. Lenders typically are not very happy about that because you didn't do your homework. And just because poor planning on your part doesn't mean they have to have action on their part. Okay, so you need to make sure that you have researched and planned well, so you know what to ask for. You're better off to get too much money than not enough. Okay, too much money is always better than not enough. At the same time, don't go blowing it, just going and asking for a bunch of money that you can't use, that you're still going to have to pay back. Okay, so I'm going to stop there for a minute. Does anybody have any questions about anything that I have gone over so far? Okay, hearing none, we will continue. Don't hesitate to ask. I talk fast. Okay, so let's talk about some sources of funding. We're going to talk about a number of different things, but just kind of the generality of what we're going to hit on are going to be grants, venture capitalists, angel investors, crowdfunding, small business association, looking at banks, and then Federal Express programs. Okay. Excuse me. So first of all, let's talk about grants. So with grants, typically you have local, state, and federal grants. Really, the biggest thing about those is who's distributing the funds. That's the biggest thing. Yeah, they usually, most grants through federal dollars, they just distribute them down through the state. They may go into local agencies and distribute them. You just have to look at them from that standpoint. There are grants available. Some key points to think about when you're looking at a grant. The application process can be very challenging to navigate. Typically, they have very strict guidelines. They'll tell you what they want and how they want it, and you need to make sure that you follow those guidelines. You need to make sure that you fall into the categories in which they're talking about too. It's the application process can be very daunting. So you need to be very, very careful about that application process, because that is one way in which they can easily weed out people that do not follow the guidelines. Then they do not have an opportunity at the grant. And that's the way they really can lessen their numbers of applications. Most grant programs are only open once a year. So typically you will have an open enrollment period for that grant. And then after that, it's closed until the next year. And it's usually the same time every year. You just have to find out what the cycle is for that particular grant. Your grants are also usually designed to fund a specific focus area. It may be something environmental, it might be human services, it could be a safety thing, but typically grants have a particular focus. Whether it's for the state, a focus for the state, a focus for a local project, it will have a very targeted focus for that. Okay. I'm going to ask everybody to check your mics. If you're not muted, if you'll please mute. We're getting a lot of feedback from somebody. Okay, thank you. And the other thing is that with grants, each individual grant program has specific requirements for eligibility. So it might be that you have to be you might have to have something in agriculture. You might have to have something that would deal more with safety, or something that has to do more with the environment. So again, they're going to have very specific requirements. It might be that the one that everybody goes back to is, are you a female? Are you a minority? Are you a first generation business owner? Whatever the case may be, there may be some eligibility requirements in there. It might be an age thing. You just don't know. So again, grants are available. They're available from a local level to a state level to a federal level. They are more difficult to find. Now, one thing I will tell you, and I should put this in big, bold red letters, and I think it actually is somewhere later in the presentation, never pay to get a grant. Never pay someone to tell you how to get a grant. Grants are technically free money. So why should you pay somebody to tell you how to get that money? Don't buy a book on how to do a grant or anything else like that. Grants are listed in newspapers. They're listed on the internet. They're listed at different resource sites. You might go to a federal grant site to find information. You may go to your local government and look for grants for that. If it's something in particular, an area that you're particularly interested in, let's say you have a small farm, then you can go look for grants that have to deal with that. So again, do not pay. I mean, you may have to pay a grant writer to write a grant, write the application for you. That's one thing, but don't pay people to tell you how to get a grant, because the guidelines are there. You just have to follow the guidelines. Okay. Then you have venture capitalists. So grants are technically kind of free money in that sense. So people like to call them. Venture capitalists are typically a group of people. It can be one, but typically it's a group of people. They're interested in high growth companies. They're interested in something that's going to grow quickly, have a lot of equity in it, something that's going to have high profits, some good returns on it. So they're going to focus on those high growth companies. They're going to invest their capital in return for equity in your company rather than a debt. So it's not a loan. They're not giving you the money and you pay them back. They want to grow their investment as you grow your company. So they are looking for this company to build in strength and value, and they're gaining value along with it as a shareholder, or having equity in the particular company. Okay. Venture capitalists are willing to take higher risk in exchange for potential higher returns. So if you got a riskier business, then they may be willing to lend money still because they see that there's a potential high return on this, and they're good with that. They're not out to make small dollars. They're out to make a lot. They're going to give you a larger investment, and they want a larger return. Okay, so you just realize that when you are looking at venture capitalists. Now, one of the nice things about it is they're in it for the long haul. So they'll do a longer investment with you typically than some lending institutions may, because they know it's going to take time to build this company up and get it to its potential value. And so they're in it for that longer period of time, which is a really nice thing. Where some people want to get in, make quick money and get out, venture capitalists tend to stay with it a longer period of time. And then we have angel investors. Angel investors. And sometimes you hear a lot about these people and sometimes you don't. Angel investors don't typically advertise themselves. Usually they're more private, well-off investors who will finance in your business in exchange for an ownership stake in again, they want some equity in the company, okay? Whether it's stock in the company, it might be, that you get the equity now and they turn it into a loan later on, or they might have it as a loan now and then later on they give it to you as you give it to them as equity. But again, they are investing in your company because they see potential growth. Okay, they see the potential growth in that company, and so that's what they're interested in. So let's look at some pros and some cons with the angel investors. Okay, so with your pros, you're looking at people who are typically experts in the industry in which your business is going to operate, or something similar to that. Okay, they don't have to be in just that industry, because I do actually know some angel investors that will invest in other types of businesses, but typically they have some kind of connection to the industry, and so they have some good working knowledge of it as well. So they've got those connections. All right. In some cases, they may be really good at introducing you to potential new customers because they do have those connections. They may also have some additional financing sources out there that they can introduce you to as they see that that is needed as well. And then they also can, help you with business partnerships and other relevant contacts as you go along. So maybe you need a new resource for a product or something that you use in your business, and they can introduce you to that because they know that industry and they know other distributors within that industry. One thing with an angel investor, they're very much interested in you being profitable, because typically with an angel investor, they only make money if your business is successful. Okay. So, in that case, they want you to be successful so that they can in turn earn more themselves. The other thing too is with an angel investor, a lot of times they'll do follow-up investments as well, and as needed. So it might be that as the company grows and you want to expand, they may be more willing to reinvest in the company to help it expand as well. Okay. So those are some of the pros that go along with the angel investors. Now the cons, and again, keeping in mind that you're talking about typically an individual that you're dealing with. So, in the sense that you've got to make a sales pitch to this person, this is why I want you to invest in my company. This is why I want you to invest in this product or this service. And this is why I think it's going to be successful. If that angel investor does not see the relevance or doesn't see that it's going to work, they may reject your pitch. Okay. So you've put yourself out there. There is not a guarantee. They could say, no, I don't see that at this time, or I don't think you're where you need to be with this. They also may ask for a larger ownership position in the company. If they're giving you a lot of money, they may want more controlling effort in that company than what you were wanting to do. You might have wanted to give them 5%, and they're going to come back and tell you they want 25%. Not all the time, but I'm just saying that is a potential, because they're going to weigh out how much they think this business might be successful versus their investment and the risk of their investment. And so they may renegotiate with you on how much ownership you're going to give them in that equity piece for them investing. Okay. Some angel investors are very helpful. Some are going to be very hands-off, and they're going to let you run the whole show. They're not going to be involved in it in the least. They just want to give you money, and they want you to just kind of report to them from time to time. Others are going to be very much involved in the business. They want to mentor you. They want to help you. So you need to look for the angel investor that suits you best. Do you want a mentor? Do you want hands-off? You've got to look at what is the best thing that you're wanting, and how does it fit with that particular angel. Okay. You might also get someone who wants to see a lot of paperwork. They may want to see income statements. They may want to see projections, balance sheets, cash flow statements, different things like that, that will give them a really close inside look. So sometimes it might be a little bit more involved than what you actually thought it would be. But again, they're going to be giving you money. They want to make sure that you've got things lined up and that you are telling the truth when you talk about the projections for the company and how did you come up with these projections for the company. And so they're just trying to protect themselves as well. And that makes sense. Okay. Then crowdfunding. I find this one very interesting and a little cautious. Be cautious, okay? But crowdfunding is happening more and more, and it's happening more and more for all types of events. The big thing I'm going to tell you is this, and I'm going to start with the last point and say it first, and then I'm going to say it again probably. With crowdfunding, when they use, depending on what kind of platform they use, if you set up anything like this, you need to make sure and read the 5-point. You need to understand what the financial commitment is and the legal obligations are to the platform that is going to help promote this crowdfunding. Sometimes, well, they'll typically charge a fee. Sometimes that fee is a lot higher than what you're expecting it to be. So you need to be very careful about what that fee is. Also, the way in which they will release the money could be, a problem. So you need to really understand the platform in which you're going to use for crowdfunding and make sure that you have read everything and that you understand exactly what it's going to cost you and how are they going to release the money to you, and how are they going to use any information that is given during that crowdfunding transaction. Okay. Very key points, very key points. So what is crowdfunding and how is it used? Well, basically you're raising funds from a large number of people. Okay. I actually know of a business that started, and this is how they did it. It was really neat. It was one of these, it was like a home shopping group. Some of you are familiar with where you can order, you tell them what kind of clothing styles you like, what your size is, and they send you, 5 pieces every month. You pick what you like, pay for what you like, send the other pieces back. Well, I had a good friend that she and I think 5 of her friends all decided to go into a similar business, not exactly, but a similar business. And so they decided to crowdfund. So each of them took 100 names, or took names of 100 friends and sent them an email and asked them if those people would donate to the startup of their business. And each of them had a certain amount that they were trying to raise. It may have been 50,000 a piece. I'm not sure exactly. I don't remember at this point, but they gave themselves 30 days. And that's the other thing. Crowdfunding, you typically give yourself, X amount of days to crowdfund because you want to create this excitement. We got to do it now. We got to do it now. And so that's what they did. And so the people, gave in anything. Most people were giving like $1,000. That was their initial funding to this group. I think in some cases, you had some people that might be doing between 100 and 1,000, kind of depending. But they made their goal. Within 30 days, they had raised the money they had hoped to start this business. So what do the crowdfunders get for this? Because technically you're investing, but you're not getting any share of ownership in the business. So usually, you're not really looking for financial return so much as you're looking at more of a gift or a discount or something like that. Thank you for your contribution. Okay. So, you look at it, and in this case, I think they were, you gave into the fund and then they, in essence, you got a discount off of what you ordered for the first year, something like that. So they were giving you a discount that would help you save money, basically, and that was your gift from the company. And that's how it often happens. Okay. So it can be the product that they plan to sell, or it can be other special perks. Anything like that can be your gift or your reward for donating to this company. Okay. Crowdfunding is also popular because, one, it's very low risk for the business owners. They owe you nothing. You gave them money, they owe you nothing. They owe you a gift. Okay. And before you ever give to them, they've already decided what it is that gift's going to be, so they can send it out. So that's it. The business owners maintain full control of the company. So you have no say-so in that company. I donated to this crowdfunding. I can't call up my friend and go, hey, I gave you X amount of dollars. I think it would be better if you advertise like this. It's not the way it works. I gave her money. She sent me a gift. We're free and clear. Okay. So they maintain full control of the company. And typically you're under no obligation to repay your crowdfunders. Sometimes they may set it up that they will repay, but typically you're giving them a gift and there's no repayment there. Okay. So that's one of the things to keep in mind. So again, back to the first statement I made with crowdfunding, make sure you read that fine print and you understand your full obligation, financial obligation, and any legal obligations to the platform that is collecting the money for you, how they're going to distribute that money to you, what is going to be their payout for that, and what are they going to do with any of the information that they gathered from the people who were giving doing the crowdfunding. All of those key points that you got to look at. Okay. Now, one of the things to kind of look at, and this is where the presentation kind of took a little bit of a tilt over the last couple of years, but it still is quite relevant today. You know, with that disaster relief, COVID funds, you know, a lot of things, those things are affecting credit-based products like loans, lines of credit, things like that. So in some ways, it's made it easier for people to get money. Okay, a lot easier for people to get money because there's so many different funds that are out to support from disaster relief or from the pandemic or other things like that. So in some cases, it's helped out in that sense. You've got repayments that have been deferred. You've got credit lines that have been raised up to give people more access to money. You've got other banking entities that are establishing credit lines ranging from 10,000 to 250,000 that are available to people for small business. So you've got a number of different things like that, even extending lines of credit to existing businesses, you know, and helping them out, or giving lines of credit to new businesses, places where they would never have given it before, but doing it now. And so much of it has to do with the dollars that are available through national different disaster relief funds or pandemic funds or things like that. So here's the thing, this is a double-edged sword. You've got a disaster, you've got pandemic, you've got easier money potentially at that particular point in time. But the drawback to that is, you know, you got costs that are skyrocketing. You've got building supplies over the last couple of years have just been out the roof. Now we're all experiencing gas prices going out the roof. So you've got reasons why we need to extend credit and you know, raise limits and so forth. So it's not like people can just go, well, this is a really good time to go into business. Again, you've got to look at that bottom line. Is this a good time to go into business? There might be some funds available, but are the natural resources available? Are the customers available? So again, you've got to still do the same research you did beforehand to make sure that you're on target. So don't just think because there's funds available, this is a really good time to do business, because it may be, but it may not be as well. Okay. All right. Before I get into this, does anybody have any questions about anything so far? Okay, hearing none, we will go on. So I mentioned to you at the beginning about fraud. Unfortunately, there's some not good people in this world, and they take advantage of other people during difficult times. Okay, so I want to make you aware of some red flags that could potentially be fraud. Okay, so first of all, with grants, your Small Business Administration does not initiate contact on any type of disaster loans or grants. Okay, so if anybody calls you and tells you they're from the Small Business Administration and that they want to reach out to you because there's potential grants or potential loans or this or that, that is probably fraud. Okay, the Small Business Administration, you contact them. You make contact to them. They don't typically reach out to you. Okay. They're definitely not going to do it through a phone call, and they won't do it through email. They would do it through a letter, and then they would give you, if they're asking you for anything, they're going to give it to you in a letter, and they're going to ask or give you a number to contact them. Okay. So again, anything like that, if somebody's reaching out to you and saying, hey, here's free money, and you've done nothing to initiate that contact, that is potential fraud. Okay. Be aware of that. Be aware about that, of that. Same thing with loans. If you're contacted by somebody promising to get you approval of a Small Business Administration loan, but they're asking you to give a payment up front, they may say, but to process this, it's going to be $125. Then you need to suspect fraud. Okay. The Small Business Administration will not charge you a payment up front to process the loan. And if you have a third party that says, I can get you a loan through the Small Business Administration, or I can get you a loan through this group, but it's going to cost you, you can work directly with that group. You don't have to have that third party person there. They're just trying to reap a profit. Okay. So again, that would be potential fraud. So anytime somebody initiates contact to you and either says, I can get you funds, a loan or grants, or they say, it's going to require a payment up front, but I can get you approval, run. Don't walk, run. Those are potential frauds, and you need to be aware of those. Another thing that is happening a lot is what we call phishing. Okay. And you have to look out for phishing attacks, scams, and they will utilize agency logos and, and popular company logos. So it might be the Small Business Administration's logo that they're going to use. It might be a bank logo that they use. And you need to look at very, very, very closely, because typically there's something that's not quite right about that logo. Or they could have just picked it up, and put it onto their document, their website, their email, whatever. But be aware, because companies, they're phishing. They're trying to gather information from you. And what they're trying to do is they're trying to obtain your personal identification number or information. So your personal identifiable information is what they're looking at. So they want to get, your bank access. They want you to install some type of application on your phone or application on your computer. They want to install some type of ransomware or malware, which are computer softwares that will take over your computer. And then they control your computer. They control everything about it, and they'll charge you a ransom for it, or they can wipe it out. They can use it in alternate different ways. So be very, very careful about what you click on as far as a website. Anytime there's a link there, if it's not a trusted site, do not go on that. Okay. If you know an agency and you've gotten an email from them and it doesn't seem right, call the agency. Ask them if they are sending out something. But you want to be very, very careful. Ask somebody to look at this with you and see if this is something, but never go to a link and then go in there and put in anything that identifies you. Not your social security number, not your birthday, not your mother's maiden name, not your brother's middle name, not your favorite dog, your favorite book, anything like that they can turn around and use. Okay. So please be very, very careful about anything like that. Okay. Business plans. You might as well get ready for it. Everybody needs a business plan. I'll have people say, well, do I really need a business plan? You need a business plan. Preferably you need to write your own plan. You need to, and the reason why I say that is because you need to know that plan. So I always tell people you need to write your own plan if at all possible. If not, then you need to have the content information, and you get with somebody that can write the plan for you. Okay. I will tell you to be careful not to just download a software and plug in things and then print it out, because it's real choppy. Okay. And it doesn't flow like a really nice plan. There are people out there that can help you write plans. There are people out there that can mentor you in doing your own plan, but just kind of look at that. But everybody needs a plan, and you need to know the plan. You need to be very succinct in what it is that you're asking. Don't try to hide things in your plan. Bankers, investors, they can read through things. When you try to hide things, they're like, this doesn't sound right. What are you planning on doing with this? So you need to be very clear. You need to be very upfront about what are your plans. Okay. You need to avoid using jargon. Keep in mind that different terms in different geographical areas can mean very different things. Okay. Even in the United States. So you don't want to use your slang terms, and you don't want to use so much jargon that nobody has any idea what it is that you're talking about. You want to avoid all the acronyms. If you're going to do an acronym, you need to write it out, then put the acronym in the parentheses so that they know, they can refer back and they know what it is that you're talking about. You'll notice I kept saying small business administration, small business administration. Well, that's the SBA. Lots of people know the SBA, but a lot of people don't know what the SBA is. So you have to kind of look at it from that standpoint. You want to make sure and tell your experience. Why is it that you're qualified to go into this business? Why is it that you're interested in going into this business? How has your experience helped you get ready for this? Okay. And please avoid fads. Avoid fads. There are some things that are not going to be natural fads. There's a lot of, I'll say, clothing, like home businesses that are kind of fads and so forth. And that's great when you first get in. But if that business has been going for a while, you may want to look at it twice before you jump in, because, there's money to be made on the front side when things first go hot, but those fads will quickly fade. So you need to be looking for what's the next thing that you're going to do. So let's say that if I was going to do a home business selling fashions, then I might hit what's hot right now. But I need to also be looking at what's the next hot trend coming down. So I'll be able to transition out of what I was selling into the next hot fashion. So I become more of the hot fashion home business, and not just the legging home business, or not just the, this home business. But it's easy to get caught up in these fads, and everybody starts doing it. And if everybody's doing it, where's your market? And how much market share can you get? Because everybody's doing it. So you have to be very, very careful. I also want to caution you that when you go to write a business plan, if you know the entity that you want to get funding from, then I would ask them if they have guidelines that they like people to follow for their business plans. And the reason why I say that is, different entities will have different things that they want to see in their plans. And so with that in mind, you want to make sure that you hit on those things, those guidelines, and that you are addressing the questions that they may have, and have it presented in the way that they want it presented. Because everybody's kind of universal in what they look at in their plans, but at the same time, they all have special things they're looking at as well. And that way you could just make sure you have that for them. Right? So banks, what banks will want to know. Banks will want to know about owner's equity. They're going to want to know what is your physical investment in that bank? What is in that business? What is your actual dollar amount investment in that business? And you can't just say sweat equity. Sweat equity cannot be liquidated and made into cash. So they're going to want to know what your equity is. Okay. Is it in the form of a building? Is it in the form of the land? Is it in the form of, I have this equipment that I'm putting into the business? Or I actually have, this amount of money that I'm putting into the business. So they really want to know what your investment is. And the main thing you can understand this is they want to make sure that you've got some skin in the game, because it's easy if you're just borrowing money to go, can't pay that off. And you don't lose anything. You lose a little bit of your ego. You may lose the inventory. You may lose the equipment. You may lose something else. But if you haven't physically invested something in that, the building, the land, equipment that you're going to lose, something of value to you, it's easier for people to just go, this is harder than I thought. I'll let it go back. So they want to make sure that you've got an investment in that. A question that I get all the time is, well, what about my credit history? Banks are going to want to know your credit history. How far can a bank go back? They can go back as far as they want. Most banks will only go back 7 years. I've known some to go back 14 and longer than that. So keep in mind, if you've got anything going on anywhere, you need to take care of it. Because it's easy for something to crop up and it just, so you got to take care of that and making sure that you've got your history clean. Okay. And do banks make concessions? Sometimes. It depends. If it's more of a local bank, they're more likely to make a concession if they have a personal banking relationship with you. If it's a larger national bank, they're going to be less likely to make concessions. So you have to kind of keep that in mind. Smaller banks, hometown banks, sometimes they've got smaller dollars to invest, but they also will invest more in local projects. Whereas your bigger banks would like to loan probably bigger amounts, and they very much have a funding formula they're going by, and they're not going to vary off of that. So you have to look at it from that standpoint. Banks are also going to want to know what kind of collateral do you have. And collateral is, what do you have a value that backs up your loan? Okay, what's going to back up your loan? So equipment may look good on paper. It is not something banks really like when it comes to having to liquidate it and take it back. So, they'll get pennies on the dollar for equipment that they have to take back. Inventory is even less. So banks are not really big on equipment unless it's something really unique and something that really holds its value. Then they may be more inclined with that. Money in the bank, of course, is always a good thing. Land, typically a good thing because it holds its value. A building that you own, again, would hold its value. So that would be something of interest and considered good collateral. And here's the one that most people don't think about. Most banks are going to say, you've got to have insurance. And it's interesting because they're going to want you to have life insurance on yourself, and if you have a partner or whatever, so that if something happens to you, there's money to take care of the bills. There's money to pay out the business. There's money to sustain the business until new ownership can be secured, whatever the case may be. So that becomes something that a lot of people don't think about, but banks will require life insurance on you, the owner, to protect their investment and the business itself. Of course, the things you think about are fire insurance, content coverage for disasters, water damage, other kinds of damage, that will, of course, help replace anything that's damaged in a fire or flood, windstorm, anything like that. So those types of insurance, people don't typically, they're not surprised when they hear about those. It's the life insurance that will really surprise people when you start telling them that they're going to need to have a life insurance policy to cover expenses if for some reason something happened to them. Banks are very much interested in your financials. Okay. So if you are a new startup business and they want to see cash flow, you can't give them a 3-year past history of a business that didn't exist. So what you will end up doing is giving them a 3-year projection. If you've been in business 1 year, then you would give them a 1-year actual history and 2-year projected. So they want to see at least 3 years of some type of cash flow. One of the things that I always tell people is when you're planning your projected cash flow, make sure you vary your expenses and your sales month to month. There are very few businesses that are operating at 100% every month. Typically, in most businesses, there's a high point of sales and a low point of sales. There are goods will cost more to sell, cost more to produce at 1 month, another time of the year than they are every month of the year. So again, you need to vary those projections. You don't just say that every month we're going to make X amount of dollars all 12 months of the year, because again, it doesn't work that way. You have highs and lows in your sales. So you have to look at the projection reflecting that as well. And again, there are just certain industries that that these are going to be top times and these are going to be low times. And you can vary your projections based on those. If your business has been established for more than 3 years, you're in luck. You just give them 3 years past history and hope those are 3 years of good past history. But you will give them 3 years of past history that they can look at to see how the business has done. And it needs to be the most current going back. You don't pick 3 years out of 5. You give them the last 3 years concurrent so they can see how things have been. You'll need a profit and loss statement. You'll need your personal financial statement and a break-even analysis. And a break-even analysis is one of those things that usually will give an aha moment to people when they, especially if they're doing selling a service. People tend to think, oh, well, I'll just make X amount of dollars and this, it's all free money. And they don't realize that there is a cost to everything that's involved in that service. I mean, you think about it, if you're doing hair, you got cost of shampoo, cost of your scissors, cost of the stuff to clean the combs and the brushes and so forth. You've got the cost of any chemical product that you're using, the cost of your water, the cost of keeping your towels and everything clean. All those things are costs in there. And you have to take a dollar figure for those things, figure them out. And then you figure out, well, am I better off to be doing more haircuts? Do I need to be doing more chemical processes? What is it that I need to be doing that's going to maximize the amount of money that I make? And how many haircuts am I going to have to get to equal this amount? How many color processes can I give to equal this amount? And how many color processes can you possibly do in a day? If it takes 2 hours to do a color process and you're open 8 hours, how many can you actually get done in that without creating an issue? Because if you say, oh, well, I can do, 1.5, 2 every 2 hours, somewhere or another, there's going to be a conflict and it's going to detract from your business. So again, thinking logically about what can you do? How much can you do in a given period of time? And what's your break even on that? Banks, banks will set how long they will let you have to pay back a loan. In most cases, a loan will be set up for 5 years, and they'll revisit that. They may ask for a balloon payment, and then they reestablish what the interest rate and the time payback is going to be for the remaining part of the loan. If you've had good credit history, that typically works really well. If you've had bad payment history, they may call the loan in sooner. They may ask you to refinance it at a higher interest rate. So you have to just kind of look at what has been your repayment history, what is the interest rate at the time, what is the forecast for that type of business. Those are the kinds of things you're going to need to look at to get an idea for paying back your loan and what is reasonable. Okay. So the last slide talks about selecting the right lending institution for you. And one of the things that I moved away from was talking so much about regional banks and national banks, because you have more of your hometown small banks and you have more of your national banks. But pretty much they've all moved to using funding formulas. Your hometown bank will establish more of a personal relationship with you. And sometimes you can go in and get a small loan faster. But a lot of it has to deal with the amount of the loan that you're getting as to whether it's a quick loan, a signature loan, or whether it's something much larger. Okay. You might be able to call your bank and say, I need a signature loan. And they may say, well, we'll loan up to $25,000 with just your signature. So you go in, you sign the papers, and then you walk away. That might happen easier at a regional bank. It would, at a regional, a small town bank, a home bank versus a national bank. Because they've got more funding formula set up, things have to go to committee. And if you say, I want 25,000, they're probably going to say, we're going to give you a line of credit. Banks really like to loan larger amounts of money because they can make more interest off of larger amounts of money. But they want to make sure that you have done your homework and you're asking for the right amount of money, and that you're not just coming in there, picking a figure out of the sky and going, hey, this is what I think I want to do. So again, research homework on your part, going to that bank and finding out what do they need to lend you money. A lot of your banks nowadays will not lend to new business startups. Okay. They will not lend to a startup. But if they really like your business plan and they really like your idea, they will send you to the Small Business Administration and ask you to work through them. If the SBA, they like your plan, they like your business idea, then they will typically either fund the business themselves, or they'll go back to the lending institution and they'll say, we will back this person in their business, which means that they're going to back you, that they guarantee 80% of the money that you borrowed will be paid back if you default on the loan. So meaning that if I went and borrowed 100,000, they like my business plan, the Small Business Administration said, we will back her loan 80%, then the gamble now to that banking institution is 80,000 instead of 100,000, because they know that if I default, they've got the SBA that's going to make it good. Okay. Of course, now the SBA is going to take my credit forever until it gets paid back, but still they are there to back up that business loan. Okay. So I have thrown a lot of information at you in a very short period of time. I am going to stop sharing bring us all back together. And I'm going to say, what are your questions? Did I baffle y'all or bore you?
Have you done such a good job, they don't even have a question about it, Dr. Singh?
I don't know. It is a lot of information. And, here's my advice to people. If you're interested in getting a loan someplace, I tell people, go have a conversation with them. Go ask that agency what it is that they're looking for, in a small business. What kind of business plan do they want you to have? How much capital do you need to have up hand? What needs to be your equity? And talk to them. Information gives you power in putting together the presentation that you need to have to go out and get the funds that you want. Okay. I wouldn't go in there and go, try to sell them your idea without doing your homework. You can just tell them, say, I'm working on a business, I'm going to be seeking funding for this. I have already put together my numbers, but I want to know the best way that I could present that information to you so that it could be considered for financing. And I think, that's an honest approach. And, I'm thinking from a banking standpoint, I would appreciate that, because then I would give you my guidelines for what I want you to do and, ask you to put it together. And that way you've got a better idea as to what you need to do to make it happen, rather than, you're just taking a shot in the dark. You go in there, you throw something on the table, they come back and they go, that's not what we need this. Okay, I go away, I do something else, I come back again. Well, you're getting closer, but we need this. So that's my suggestion to people, is that you interview potential bankers, and some you can't. I mean, you're not going to be able to go to the SBA and interview them, but you can call them and ask them questions and find out what it is that they do, what can they do for you, how can they help you, and that kind of stuff.
Good, Miss Becky.
Yes.
How often, if any, should you change your business plan?
How often?
Yeah. Or
Well,
if should
good question. I think it depends on the business. And I think it depends on how often the business changes. And probably you don't have to change the whole business plan, but you can make an addendum to it, or you can. And so let me go back and preface that comment. So let's say that I open a business and I'm all by myself. Okay. And so I've written my original business plan. And so that I'm going to be the sole proprietor. I might even do an LLC for myself. I'm going to be the manager. I'm going to have 3 employees that are going to help me. Well, let's say after a year or two and the business is growing, and so I have taken on more of a role of if I'm doing a bakery, let's say I'm doing a bakery, that I'm doing more of a role where I am actually doing the baking. And so I have hired somebody else that's going to be managing the business. If I'm not going back and getting additional funding, then I can just make myself some notes, on this plan, or when I've got time, I can go back and redo the plan so that it reflects that. Now, if I need additional funding because I want to up my kitchen, I want to expand my kitchen, I want to do that, then I've got to go back to this plan and I've got to make those edits in a professional manner. And I've got to now talk about Becky Sane, who is our chief baker, and that we need to expand the kitchen and we need to get this equipment and that equipment so that she's better able to prepare these wonderful dishes that her partner or her her manager, is going to be running the storefront, and the manager will be doing this, and the manager has this expertise, and we're hiring, 3 more additional employees. So if you're going back for funding, then I would definitely redo this plan that shows, originally this was, originally this was what the business was doing. Well, over the last 2 years, we've now expanded the business to be this, and that would be in my narrative. So they would see that this is what we were doing, and this is now what we're going to be doing based off of the growth of the business. Does that make sense? So I don't think there's a key. I don't think, in my mind, I have never told anybody you need to update your plan every year. There are some people who feel like they need to update their plan every year. There are some people who will say, well, I haven't touched my plan in 5 years. Well, you better go back and read that plan, because if you haven't touched that plan in 5 years, it's probably out of date. So you just need to stay in touch with that plan to make sure that it's current.
Okay, thank you.
So somebody put a comment in here, and it's hard for me to get to the comments. Let me see. How do you decide how generous to be with paying yourself on the cost projections, especially when doing multiple jobs within the business? Okay, well, that's a really good question. So this is the way I typically address that. So one, if you've been working for another place, I don't care what the job is, but if you've been working somewhere else, and you need to maintain that same salary, the easy thing is you're going to take what you were making and you're going to add 35% to it, because that's going to pretty much equal what you were being paid plus your fringe benefits and your federal and state withholdings. Okay, because you can pretty well figure 35% is vacation, sick leave, and your withholdings. That's probably what that figure adds up to. Now, if you say, well, I wasn't working for anybody, I don't know what they ought to pay me. Well, that's when you have to figure out how much money do you need to make? Okay, reasonably, how much money do we need to make? Because everybody wants to make more money than what they make. Nobody ever gets paid enough. I'll just go ahead and tell you that. If you get a raise within 6 months, you need more money because you've already encumbered that money somehow. So, but you might sit there and you might add up all your bills and say, this is how much money I need to be paid because this is my bills. This is what it costs me to live. And so, you figure out, what is a reasonable wage based off of what you need to bring home. And then that would be what you would strive for the business to pay you. Now, you got to kind of be realistic about this thing. You got to look at it from multiple angles. One of the best businesses I ever worked with was a couple, and they opened up a business, and he stayed at his full-time job, and they hired a manager to run the new company. And he would come at night and he would, help when he got off work, and she did the books. So they, and then on weekends he would go when he'd work in the business, and she'd keep the books. The next year, and I think the first year, the company just paid him a nominal amount, almost like hourly for when he came on the weekends to work. Okay. But he had his full-time job and his insurance and everything else there. So the company didn't have to pay him more than that. The next year, he got to where he would come a little bit more. They still paid their manager, but he would come a little bit more. And so the company paid him a little bit more. And then the third year, he decided to retire, and the company, of course, then upped his salary to, pay him more. It didn't pay him probably his full salary because he was making his salary through his retirement, but it still paid him well. So, gradually they got to where they needed it to be, and it didn't tax the company, but it gave him something, and it got the company used to paying him something. Okay. So it's kind of hard to say exactly how do you figure it out. I always tell people you figure out how much money you need to make that's reasonable. And that's where the company starts looking at what they pay you. Does that help? What else? Well, I'm impressed there's no other questions. There's so much we can talk about when it comes to financing business or just business in general. If you got questions about other things, I'll be glad to answer those.
Good job, Dr. Sane.
Thank you, sir.
Everybody got the answers before they even had the question idea.
There we go.
Ms. Becky, I have
Yes.
one more question. The PPP loan.
PPP loan.
Yeah, do you know any?
Wait a minute. The PPP loan? What's?
Yes, ma'am.
Payroll protection.
The payroll protection.
Oh,
Do you know
Okay.
anything about that?
no.
Okay.
Now, sorry. I've heard of it, but I have not looked into it. And I apologize. I should have, but I just did not look into that. I wish I had a better answer for you.
You can blame that question on my husband.
I knew there's a voice in that background. I heard that voice in the background. There we go. So leave it to him trying to stump me up for that one. No, I wish I had a better answer for you, and I don't mind looking at that. And I don't know, Steve, help me out.
Right now, they're struggling to decide how they're going to handle it, but the PPP loans for the original COVID situation was discontinued some time ago. And I'm not sure they've started it back yet. I have not seen anything that says it's coming back online. It was very successful. A lot of businesses were able to survive because they were able to get a payroll protection plan loan. But right now, I'm not familiar with anything that's open at that level.
Thank you, Steve.
Mhm.
We did have another question pop up about what are my thoughts about starting a business with a credit card. So I'm going to approach it from this. Area. I have no problems with a business having a credit card. I think a business should have a credit card. Or a debit card or something. Now I would say a credit card because debit cards are too easy to hack if you are out purchasing something, where credit cards give you more protection if somebody were to get hold of the information and do fraud. So as far as a company having a credit card and being able to purchase with that, but I will tell you this, using a credit card to finance a company is a bad choice. And here's my thing. Most credit cards, interest rates are anywhere from 12.5% to 24%. And I think a business credit card is just like a personal credit card. You have to be able to manage that credit card. Okay. And I have watched people before. I'll give you a scenario, and it didn't happen here. It happened somewhere else because I work with businesses all over the country. But I knew somebody else that they got a business loan, and they only asked for $25,000. And I was like, you need more than that. Well, their inventory is only going to cost them $25,000. Well, that's great. But guess what? They did not account for that monthly operating cost. Okay. They did not get themselves any operating capital. So they immediately spent the $25,000 buying inventory. Well, then they had to start using the credit cards to pay their monthly bills. Then they had to use the credit cards to buy the additional inventory when the money, when the inventory got purchased and they needed it repurchased, they had to use the credit card for that. Next thing you knew, they had maxed out every credit card. They had no more credit. and they do not have the cash flow, enough cash flow to pay down the credit cards or the loan, and they end up going out of business, owing a lot of money. Okay, about $50,000. So the credit card is about double their debt. So here's my thing. Having a credit card to pay for expenses as they arise is fine, but you must turn around and pay off the credit card. Okay. You know, and a lot of this depends on how much money are you talking about. Okay. Because if you're talking about, I'm going to start up a small business and I need $5,000, you know, that might be doable. That might be doable, although you might want to go to the credit union and get a line of credit, or you might want to just go to the bank and get a line of credit for that. If you can't get a line of credit, then you might, you know, you could possibly use a credit card, but you got to be able to pay it right back off, because you can't carry that debt. And what happens after that is, you know, you use that 5,000. Well, what are you going to do for the next round of expenses? You have no more, you know, disposable means there, because the credit card is gone. So having a credit card and using the credit card to actually be the financing of the business is typically a bad way to do it. Just kind of the rule of thumb. Okay. Other items. Now, what you might want to do is you might want to get a line of credit with the supplier, and that allows you to be able to pay them over a period of time. A lot of times too, you got to think about when you're selling a good or a service, who are you selling it to? Because if you're selling business to business, a lot of businesses have a 90-day turnaround payback. So you might be self-financing for 30, 60, 90 days before you get paid for that good or service that you delivered to a business. So you have to kind of look at it from that standpoint and see, you know, what's the best way for me to go with this. Anything else? Well, I appreciate your time, and I hope that this has been of some benefit to you. We will have other workshops.
We appreciate your sharing the good information that you have, and I think everybody learned some